Hello, I'm Paul from Bezla. Getting funding to set up a hotel can appear daunting, but there are more hotel financing options available than ever before. So today I'm going to look at what you need to get hotel financing. The accommodation market is constantly changing, with smaller scale hotels on the rise. So this program will give you a solid foundation in what you need to get your project off the ground. Whilst high-profile branded hotels still dominate the market, the reality is that hotel investment is a big risk for investors. So there is a trend in lenders being approached for funding for smaller scale hotel projects like economy and mid-scale properties. These projects are seen as bearing lower risk because they have a lower cost basis, which can make financing easier to secure. Independent hotels are becoming increasingly popular with travellers, and in some markets are actually outperforming flagged hotels. The most successful independent hotels are often those that offer a more boutique experience and cater to a highly targeted customer niche. They might offer spas, body treatments, gyms and pools, which can also be used to supplement income from accommodation. Across the board, lenders are less cautious than in previous years. This means that an experienced hotelier with a successful track record entering a recognised market has a good chance of securing the necessary investment. Putting in a significant amount of equity and finding a lender that believes in the project will also be very advantageous. If there's a large property improvement plan or PIP, then you need to factor it into the financing request. All brands will be looking for a good return from a new operator. If you're buying a property that's a bit dated and the brand wants to maintain the flag, then it's going to ask for a pretty significant PIP to extend the franchise. You need to establish what type of financing you and your investors are looking for. Commercial mortgage-backed securities, or CMBS loans, also known as conduit loans, are one of the most popular ways to finance commercial real estate in the United States. CMBS loans have both advantages and disadvantages. A CMBS type of finance structure will give you good leverage, but you're going to be tied up in it for a while and you won't have a lot of flexibility on the back end. If you're willing to guarantee, do lower leverage and maybe get a better rate, then consider a bank. Banks will typically provide 3 to 5 year loans. Banks are selectively looking for development financing opportunities, but bank debt is still in the 60 to 65% range on construction financing. On CMBS, you can get up to 80% provided you're willing to incorporate a mezzanine loan into the deal. If you're looking to quickly get in and secure an asset, then you may opt for a balance sheet loan. This will allow you to hit your performance criteria and refinance out of it to recover your equity. With a bank loan, you aren't going to get as high a leverage and you're going to have to guarantee, but you will get lower pricing and more flexibility in your structure on the exit. There is something of a myth around new construction. By and large, banks are not so attracted by new development because they get a better return with a lower risk from financing existing property. If existing assets are available, the banks are going to go after those first. You'll need a lot of luck for a bank to do a new construction deal. Getting a $10 to $20 million loan on a select service property in a secondary market remains difficult to achieve. But as lenders build their portfolios, they are providing better terms. With assets performing well, investors are more comfortable investing in this space and they're becoming increasingly competitive, which of course is an increasing benefit to anyone seeking finance. If Bezla could be of service to your hotel marketing, visit our website at bezla.com or give us a call at 888 999 8086. Thank you for watching today.